the idea of paying yourself back interest the number one lie of the infinite banking concept, or the number one like misdirection or like just bad education?
Okay, so here it is. Here's basically what it means to pay back the interest back to yourself. With infinite banking, as we know, we generally speaking work with a mutual company. Mutual companies, when you are a policy owner at a mutual company, or you own equity in the company, versus a stock company where you don't actually own equity.
And there are IBC practitioners out there that I've talked to that will tell that are selling people on the idea that extra interest, you can write that off as a business expense. And that's a real, like, if you want to deal with getting audited. And hey, what's going on, cash flow hackers? It is Chris and Cole with Life 180. And today we are going to be talking about something. Cole's kind of fired up about it. And we were talking about this topic and the idea of paying yourself back interest in infinite banking, and how, this has been, when Cole and I first talked, Cole's an authorized IBC practitioner and all that stuff. And, so this is one of the areas that when we first talked, I have a huge point of contention with the infinite banking people of the world, who like to tell people that you can pay yourself back interest. And that's a big kind of function of the infinite banking concept, and how you can leverage the idea and the strategy to create wealth in your life. And, for me, it's kind of BS, because, well, it's complete BS, first of all. Secondly, the reason I think it's so important for us to go through this, I would consider the idea of paying yourself back interest the number one lie of the infinite banking concept, or the number one like misdirection or like just bad education about functionality, about how the system works. Because like, if you really look at it, like, here's the bottom line. Cole and I both believe so much in the idea of leveraging whole life insurance as an asset, as a savings vehicle. And the thing is a confused mind always says no, right? Like, and if it looks too good to be true, if it doesn't make sense, and if there's incongruency, like, people, you're just going to look at it and you're going to be like, that doesn't make sense. Like, try to make that make sense to me. And if I could probably try to like finagle a way to make it make sense, or whatever, like other IBC people, to convince you that you're paying yourself back interest. But the reality is the moving parts of the money just don't work that way. And so, I think the concept, the structure, the foundation, the moving parts, getting your money to perform more than one function, getting your dollar to be able to work in multiple ways with the same dollar, that's where the power is in this. It's not paying yourself back interest on money that you're borrowing from yourself in the way that they do it. So I'm going to shut up for a second, because Cole has a lot to say on this topic. And so Cole, if you can, like, dude, hop in here, talk about this. I know you're fired up about it, and then we'll kind of go back and forth on it.
Right. So yeah, totally, Chris, and I totally agree. And I think as infinite banking becomes more and more popular, I mean, it needs to become more and more popular. It's probably the number one solution to the biggest problem facing North Americans today, facing debt, facing financial literacy, fear of money, opportunity cost. You could go down the laundry list of problems that we have. So it's important that when we're talking about infinite banking, we're talking in a critical way. We're talking about, what it is and what it is not. What is the number one problem that it solves, and what is the number one misconception? And I do believe wholeheartedly that the number one misconception about infinite banking is the idea of paying interest back to yourself. To your point, what does a confused mind say? It says no. We have a lot of advisors watching this. You that are watching this right now, you are watching a channel that a lot of financial advisors are watching. So Chris and I are constantly delivering content, really facing the advisor, knowing full well that the consumer wants to watch what the advisors watch. When advisors go into a meeting with a client and they're starting to broach the subject of paying interest back to yourself, watch the advisor melt down. Watch the advisor not actually be able to explain what it is that they're trying to sell, essentially. You read it in the books. I mean, there's fewer books, contemporary books that speak to it. There's some older books that speak to the idea. The idea of paying interest back to yourself, as written by Nelson Nash in Becoming Your Own Banker, is very metaphorical. The entire book is very metaphorical. The financial industry is described, whether you're watching CNBC or Bloomberg or what have you. If you watch it today, go watch CNBC or Bloomberg, and you're going to hear talking heads like Chris and I are right now, describing financial conditions through metaphor. A rising tide raises all boats. Things like this. It's constantly being described through metaphor. The idea of, but we have to take metaphor and make it critical. It has to become mathematical when it faces the financial industry. So, I mean, I could go on and on about this, but it is real. So if you're an advisor or you're a potential client of the infinite banking concept, ask your advisor, show me show me a policy that you own. I mean, you should never be doing business with a financial advisor that doesn't own a properly designed whole life insurance policy, that it isn't cash flow hacking, that isn't leveraging the policy in a cash flow forward way. And then ask them simply, well, show me how you're paying interest back to yourself. Capture that. Like, show me on a spreadsheet.
Right.
Draw for me how you're. I'm going to pass it back over to you, Chris, and then when I go again, I'm going to break down, what they mean by the concept and what is the truth about paying interest back to yourself versus what is the actual reality.
Well, right, and so I want to throw this caveat in here too and say that just because you're not paying yourself back interest, I feel like it's almost a crutch that these advisors or agents are leaning on to try to make it seem sexier than it really is.
It's already so sexy.
Something.
Like it doesn't. It's so good.
Totally.
We don't need that.
Totally. 100%. Right? And so that's the part that blows my mind. Yeah. It's like, why focus on something as an agent that's just going to confuse people and, quite frankly, confuse yourself when you're just trying to make it seem better than it is already amazing. You know what I mean? Like it's just, there's no point. Yeah. You're focusing in the wrong areas. And so the bottom line is this: when you look at a policy, it's important to understand. So languaging matters, words matter, right? And so when you think about you're saving up capital inside of a policy, let's just talk about the moving functions of these policies, right? And kind of like the internal workings. I don't know if this is where you're going to go.
No,
next,
we're totally in sync. Yeah.
So you save up. Let's say you save up over a 5-year period. You're putting $20,000 a year into a policy, and let's say you got let's say you have $100,000 after year 5, liquid, accessible, whatever in the policy. And so in that policy, you want to borrow against the policy, right? Notice I said borrow against the policy. It's important to understand you are not borrowing from yourself, right? Like that. Like, so if you are not borrowing from yourself, how can you pay yourself back? Right? Like you're borrowing from a financial institution. The life insurance company, you have a unilateral contractual right to borrow against that money and collateralize the capital inside your policy to access it and leverage it inside of a system. That's all this is. This is a system to allow you to run on a track that will help you leverage your money, that will help you operate and create behaviors, systems, decision-making processes, all these different things that are going to help you like invest for cash flow in other are's, right? Like that's what this is all about.
So you're describing right now the idea of OPM, and you hear a lot of infinite banking practitioners they'll say two things, but they're totally contradictory, but yet they're intending it to mean the same thing. They'll say, well, would you rather spend your money? Or would you rather spend the life insurance company's money? And we're describing OPM, other people's money. Mm-hmm. Then they're going to say, well, do you want to spend your own? Do you want to spend your own money, or do you want to spend someone else's money? Do you want to pay interest back to the life insurance company, or do you want to pay interest back to yourself? The idea is that these two kind of ideas are totally in conflict with each other. Yeah. You're really borrowing money from the life insurance. Are you borrowing money from yourself, or are you borrowing money from the life insurance company? To your point,
from the life insurance company.
You're borrowing money from the life. Your money is technically still at the life insurance company, in the life insurance company, being treated by the dividend, being treated by a compounding effect. So you can't really borrow your money 2 times. You have to have the mechanism or the intermediary of the financial institution. In this case, it's a life insurance company.
And that's the power in this, right? That's the leverage because if you were to like access your own money, there could potentially be tax consequences, right? But the fact that you're borrowing the life insurance company's money and they're literally just using your money as a guarantee to make sure that no matter what happens, that's what gives you the guaranteed access. But at the same time, if you're going to pay money over here to access this money from the insurance company, which you are, there's always going to be a cost to borrow money, and your money's going to be sitting still in your account compounding for you. That's the leverage. That's the power, right? And so that's where we get into other concepts where some people have a problem with it and some people love it. I happen to love it. The whole idea of cash value lines of credit and leveraging, because anything we can do to lower the cost of acquiring money and accessing money, that's just leverage. It's just more opportunity. It's more power. It's more control. It's more like flexibility in what we want to accomplish. Yeah. And so like that to me is what this is all about, is like creating a system. When you think about infinite banking, get out of the mindset like of thinking you're paying yourself back interest and all that stuff, because you're not. Realize the fact that you're really invested in a system that's going to force you to operate systematically in a way that's going to, how do I put this? That's just gonna give you a set of rules and behaviors, right? That will help you accomplish what you want to accomplish on a predictable basis.
Yeah,
like
it's a paradigm. It's a paradigm shift, and it's a paradigm shift that will erode into other aspects of your life. The beautiful thing about infinite banking, when it's done and explained in a very simple way, is that, and again, many of my mentors are from the Nelson Nash Institute, and they've taught me, they've definitely taught me more than not. There's more value in, for me working with this group of people than not, for sure. Ideas like when you are, and again, it's kind of metaphorical and it's kind of vague. It's very macro in its approach. Ideas like when you start infinite banking, opportunity will track you down. I mean, these are kind of ideas extracted from the Bible of infinite, the original Becoming Your Own Banker Nelson Nash book. And if I look at that critically, do I say, since I started infinite banking, has opportunity tracked me down? I can critically say yes. I mean, absolutely. My life is better because of the paradigm shift that I've made and how I look at my life. Now, the one thing I wanted to unpack a little bit is, now, is there any truth to the idea of paying interest back to yourself? And there is. It's just that the truth, and look at Chris's face. Now, the truth of paying interest back to yourself is so far removed from the reality, and it's a fractional, it's a strand of truth. I mean, it's basis points of reality away from, really a whole number of paying interest back to yourself. Okay, so here it is. Here's basically what it means to pay back the interest back to yourself. With infinite banking, as we know, we generally speaking work with a mutual company. Mutual companies, when you are a policy owner at a mutual company, or you own equity in the company, versus a stock company where you don't actually own equity. The two pools of money in a life insurance company that's a stock company is a participating pool for the participating whole life insurance holders, and then there's also the stock. The argument is, at the end of the day, if there's systemic failure or 2008 happens all over again, if there's two pools of money, is one going to be used to help the other? And it's highly likely that the people that are in the participating side, or the whole life insurance, dividend-paying whole life insurance side, that money be taken to keep the stock holders and the shareholders happy. Okay, so big advantages to being a mutual company. When you put a premium dollars into a mutually owned life insurance company with a properly designed life insurance contract that you would have for infinite banking, your money goes into this pool. When you're paying interest back to this pool, you are an equity shareholder. So the company is then taking your dollars and putting it to work and feeding you back a very, very small percentage of the returns. Your dividend is set forward 365 days ahead of time. It has been essentially guaranteed. It works on a guaranteed and non-guaranteed basis, but in almost 200 years, life insurance companies have never not met the non-guaranteed dividends. So you can say they're virtually guaranteed. So it's even suggested that as a participating or a whole life insurance policy owner, you should pay back more interest in some cases, which is even kind of more crazy. So if say the interest rate is 4 or 5, 6%, you're then paying 10%. The thinking and what's misleading is that we're kind of assuming then that 10% is coming back to us tied to the general dividend that the life insurance company is paying back to all of the whole life insurance participants. And that's just not true.
It's just a lie.
It's just not. I mean, it's just not mathematically, accurate. If you were to measure that, and you were to say receive the benefit of paying extra interest back to your whole life insurance contract, you would have to essentially be the life insurance company's only client, like their only customer. You'd have to be making premium payments of tens or hundreds of millions of dollars a year, because then you would in essence own the company, and then the interest is potentially kind of coming back to you.
But it's even worse than but just think functionally. If you have a policy, let's go back to the $100,000 over a 5-year period that we're talking about, and you're borrowing against it. If you borrow $90,000 out of that $100,000, and you're paying yourself back interest, right? Like what you're doing, you're not paying yourself back interest. You're paying back the interest to the insurance company. If you decide you want to do that, it's in an unstructured capacity. Mm-hmm. But anybody that tries to say from an infinite banking perspective, like you can choose to pay yourself back any interest amount above and beyond that you want, all you're doing when you do that is recapitalizing your policy. Like that's all you're doing. Mm-hmm. You're because you can't choose to pay yourself back interest. Like the insurance company has an interest amount that they're charging you. That is fixed. Like you're going to pay that. Anything above and beyond that you pay, that money, you can call it an interest rate if you want. All it's doing is recapitalizing your collateral capacity inside of your policy, and it's increasing your liquidity in the policy. It's a really good thing. There's a lot of really good things and a lot of reasons I could tell you that it makes sense to do that and that I would suggest doing that. But to call it paying yourself back interest is a bunch of bull.
There's no mechanism within any life insurance companies in Canada or the United States to actually pay yourself interest back. There's no line where or data point or cell that you can populate to describe how much interest. If the interest rate that you've contractually agreed to paying is say 6%, it's either the interest is going to be kind of taken out on a capitalized basis, or you're going to make a line item payment, especially if you're borrowing to invest. If you're borrowing the money out of your policy to reinvest it, you'd like to create a line item on the actual balance sheet so that your accountant can write that down. Otherwise, what's going to happen is if you don't do that and choose that option, then the interest is just going to capitalize like it would say in a line of credit, for example. There's no mechanism. Say you wanted to pay back more interest to yourself. There's no button to push. There's no mechanism to account or to measure how much. So when you do say in your mind, well, if I take the net amount of money that I need to pay back with interest for my monthly loan to my policy loan, say it's $100, so I'm going to pay back $106. Well, actually, I want to pay 10% interest, so I'm going to pay back $110. That extra $4 isn't going back to the interest, and it's not coming back to you. All that $4 is going to do is go to reduce the debt on your actual loan. It's going to be looked at as a loan payment. It's not an interest payment at this stage.
And right, exactly. And that's a big important thing to understand. There are IBC practitioners out there that I've talked to that will that are selling people on the idea that extra interest, you can write that off as a business expense. And that's a real, if you want to deal with getting audited and deal with like real accounting problems, try to pull that off for too long and you're going to get busted. Life
insurance, they're going to audit you. The life insurance, they're going to audit the balance sheet or your statement from the life insurance company. Mm-hmm. And the life insurance company is just going to say, no, we just charge them 6% simple interest. Calculated on a daily basis. Well, he's writing down 10%, or she's writing down 10%. Where does that? They're just like, well, they're just kind of making that up.
Some fictitious number.
Yeah, I mean, it's just and especially if you're scaled and you're doing it on a big level, you're going to a world of trouble.
It'll catch up.
The Canadian Revenue Agency is a lot more lenient than the IRS. I mean, the IRS will just straight put you in jail. In Canada, they'll just send you.
They'll just take all your stuff, man. They'll just take all your stuff. They're no joke. So, largest collection agency in the world, the IRS. So anyway, do you have anything else on this, bro? Because I think we tapped it out pretty good.
I got so much to say about it. I mean, we could do a whole series. So the thing is,
we'll do more videos.
Yeah, you're watching this. do it. There's so many advantages. I mean, just kind of cut through that.
Yeah.
Ask your advisor to show you critically how this actually works. Ask them to draw it out mathematically for you. If they can't draw it, if they can't get on a whiteboard and draw it out mechanically for you, if you're asking them questions about infinite banking and you feel that they're struggling with some of the metaphor, then look for a practitioner that can answer. There are practitioners out there or infinite advisors out there that can answer these questions on a critical basis, and just keep looking for that. And most importantly, ask your advisor to show you the policies that you're using. Chris and I both own them. I have 11 of them. I do this every day. Years ago, I searched for that little button as to I want to start paying back extra interest to myself, and it's like, lo and behold, hey, I can't do it.
Oh yeah, it doesn't work that way. No, that's awesome, man. Well, guys, I hope everybody found value watching this video. If you did, please smash that like button. YouTube algorithm loves it. At the end of this, on the end screen, you're going to see we're going to have a playlist there for infinite banking training. A lot of these concepts, we're really passionate about this. We're adding to this playlist all the time. Favorite it, get in there, watch it. I think there's probably 20, 25 videos in there already. So if you're interested in learning about infinite banking from a agent perspective, and you're looking to help people with this concept, implement it in your practice. If you're looking at, as a consumer, possibly leveraging this strategy in your life, the content in that playlist is going to be super helpful. So go on, check that out. Make sure you continue the educational journey. If you have any questions about anything at all, whether you're in Canada, whether you're in the US, go down below, look in the description. There's links. You can set up calls with somebody on the Life 180 team to be able to help you out, give you, we call it a free clarity call, because the bottom line is having clarity about the why, the what, the how behind everything that you're doing with this is the most important stuff of all. So go check it out. Stay plugged in, get involved. If you haven't already, make sure you hit that subscribe button. That way you get notified every single time we launch a new video. Hit the bell, that way you're notified. And that's it for now. So I hope you have a blessed, inspirational day. Thanks for being here, Cole, and we'll see y'all later.